Certainly, we can start off with the current Chinese currency, and obviously we haven't seen a month like this where, despite the broad dollar weakness, we are still seeing renminbi that is weakening, and maybe it does show that this is more about Chinese fundamentals now than a stronger dollar story. What is your take overall of the economy now in China?
I think the pressure the renminbi is under says more about the US in a way than it does about China itself. The most reliable guide to the near-term renminbi is the US-China interest rate differential. And since the market's expectation is that US rates are higher for longer, that puts pressure on that interest rate differential and therefore sucks capital out of China towards the US. So it's really the sense in which tightening US monetary policy and the expectation that US monetary policy remains tight act as a kind of magnet for capital flows from the rest of the world, which is why it's not just the renminbi, but other emerging economy currencies and the yen that are all under pressure. In fact, it's possible to argue that in the last few weeks, we've seen slightly better news out of the Chinese economy, starting with the April Politburo meeting, which committed to providing more support for the housing market, allowing for central bank funding of state-owned banks and local governments to scoop up unsold property, easing housing purchase restrictions across a number of cities in China. And indeed, industrial production figures for April show, for the first time since May 2022, that the growth rate of industrial production of private companies in China is outstripping the growth rate of state-owned companies. So there's actually some reasonably good news taking place in China, which slightly sort of flies in the face of the news coming from the foreign exchange market.
Yeah, and David, to your point, do you think authorities have a reason to step in? Should they step in and stabilize? Or is actually a weak currency doing China some favors right now, particularly around the export story, too?
I would say that allowing the nominal exchange rate, the dollar exchange rate, say, to weaken doesn't really do much for Chinese exports, particularly against the background where in the last couple of years, the real effective exchange rate of the renminbi, in other words, the trade-weighted, inflation-adjusted exchange rate, has already depreciated by around 15%. So Chinese exports are already super competitive, and so they don't need additional exchange rate support from that point of view. There is one sense, though, in which a weaker exchange rate might be convenient for the Chinese authorities, which is that, on balance, a weaker nominal exchange rate might help to ease the threat of deflation in China. In other words, to the extent that a weaker nominal exchange rate helps to raise the domestic price level in China, that may help to kind of deal with the deflation problem that China's kind of flirting with.
Yeah, I was about to ask about the inflation part of the conversation. David, just hold on just very quickly here. So we have the reference rate of the day out, 7.1111 against the U.S. dollar. That's the sort of playground and the sort of parameters of the playground today. David, let me bring you back in on the conversation around inflation. Do you think the lack of inflation in China, is that something you think authorities have a toolbox to effectively stimulate and get themselves out of this current hole, David?
I think it's very tough. By far the most reliable tool to kind of allow the Chinese economy to exit this deflation trap would be substantial fiscal loosening. But for all sorts of reasons, the Chinese authorities are really quite reluctant to deliver that fiscal loosening. One reason is that philosophically they are just against what they call welfarism. They don't like the idea of handing out money to households for doing nothing. Partly because their idea is that once you start handing out cash, it's difficult to bring it back. And so it's a sort of slippery path to unstable public finances. And maintaining stable public finances is a big priority for the Chinese authorities. But there's also a kind of behavioral factor behind their unwillingness to deliver a massive fiscal support, which is the idea that they don't want a kind of a culture of dependence. They don't want, the Chinese authorities want to make sure that Chinese households remain nimble and robust and don't become, if you like, lazy in the way that Xi Jinping once described Latin American countries for their tendency to rely on fiscal handouts. So there's both a kind of fiscal or financial stability aspect to China's unwillingness to stimulate, but also a kind of behavioral aspect as well.
Yeah, you mentioned financial stability, and it's interesting, when you're seeing, I want to broaden it out to what we're seeing in the global economy, particularly in the U.S., where, you're starting to see disinflation stall a bit, maybe in parts of Europe as well. You're starting to see PMIs that are still resiliently strong. I mean, is there a cost to this sort of robust growth that we're seeing in the world?
Yes, I think that's right. I mean, the good news is, as you say, we've had 3 consecutive months of global manufacturing PMIs above 50. So there is a sense in which the long manufacturing recession that the world was under during the course of 2023 is coming to an end. But at the same time, global commodity price inflation is now becoming a threat to CPI. A major contributor to the disinflation process in 2023 and early 2024, in advanced economies certainly, was the fact that global commodity prices have experienced negative growth. In other words, there's been deflation in global commodity prices during the course of 2023 and early 2024, according at least to the World Bank's commodity price index. In April 2024, we had the first month of positive inflation in global commodity prices since late 2022. And as goods and the price of goods inflation starts to increase, then the threat to CPI becomes more evident. And so global CPI, or at least advanced economy CPI, is more likely to be threatened upwards by this revival of global commodity prices, which in turn, I guess, is to some extent a function of this global manufacturing revival.
Yeah, David, we were speaking with Olivier Blanchard the other day, and he was of the same view that almost nothing that's brought inflation down was because of tighter monetary policy. Do you think monetary policy officials, particularly at the Fed, should be tempted to tighten policy even further if that's the case? And separately, do you think Fed rates are restrictive enough at this point in time to bring to get us that last mile down on inflation?
I think it's worth being patient at this stage. Real interest rates in the United States are relatively high by historical standards. And because we have evidence at the moment that the labor market is softening, I would imagine that it makes sense for the Fed to pause, not rush in either to hikes or cuts, in order to see whether this apparent weakness in the labor market and the weakness of retail sales, for example, starts to kind of feed through into inflation expectations. In other words, it's worth waiting for some time in order to see whether economic weakness in the United States can do the job of monetary policy, or can assist the job of monetary policy by easing inflationary pressures in the near term.